Good day, fellow investors. Value investing is about taking advantage of the opportunities the market gives us. I have created this value investing quadrant to focus on value investing and to find those opportunities that are low risk and high reward. Because that is the essence of value investing, thinking that low risk leads to high rewards. And for that, having such a quadrant where you put all your investment opportunities to see where are the best buys, where you cannot lose money because the risk is low and therefore the reward is high. It is a little bit counterintuitive. It is against what you learn in school, where high risk equals high return and low risk equals low return, but value investors think the opposite way. For those who don't know me, my name is Sven Karlin. I run a nice value investment channel on YouTube, and you might want to join us if you like value investing. So let's put this risk and reward thing into perspective. If I look at the S&P 500, now close to 6,000 points, when was it the best time to buy? Of course, the best time to buy it was when it was cheaper. I believe the low was at 666 points. And academia would say that the market crashed 50%, almost more than 50% then, and that therefore it is extremely risky because academia measures risks as volatility. However, I would argue, and value investing is about focusing on the price. Suddenly, the same assets were 50% cheaper and therefore a better investment. Lower risk and higher reward. Of course, those that invested then enjoyed great rewards over time, and mathematically, those that invest now will see lower rewards because the price is higher. Because when it comes to value investing, risk is defined as the possibility of long-term permanent capital loss or the achievement of long-term unsatisfying investment returns. Therefore, you have two key risks, a business risk and a price paid risk. When it comes to the S&P 500, I don't think there is a business risk. It is well diversified, it is a representation of the best businesses in the world, no question about it. So it is extremely likely that the S&P 500 will be there in the next 50, 100 years. However, when it comes to price paid risk, the current cyclically adjusted 10-year average earnings P ratio is 38, more than double the historical averages. And when the P ratio is high, then the returns, the long-term returns is low because the price paid is high. When the P ratio is low, the returns are high. As we discussed, low risk leads to high returns. High risk leads to low returns. Totally the opposite of what you likely have been learning in school. And to put this into an easier perspective and something that will give you a tool to use whenever you analyze whatever investment opportunity, let's put that into the value investing quadrant that we have already filled here with many stock analysis, and in the description of this video you will find each stock with a relative analysis video. So where do we put the S&P 500 here? As the price is very high, it will not go bankrupt, but the price is high, therefore the reward will be low and the risk is also high from that price perspective. The rest is fine. I would love to buy the S&P 500 on the cheap side. We'll discuss that in a moment. So whenever you find an opportunity, you first ask yourself about risk. What can go wrong? We have already discussed business risk and price risk, and the same as with the S&P 500, I don't think Berkshire Hathaway has a business risk, but it does have a price risk. And you can see here on repurchases made by Warren Buffett, he has lowered them and practically eliminated them recently because he thinks the price is too high compared to the reward. And when it comes to the reward, the thinking is, okay, risk, what can go wrong? Reward, what's in there for me? Berkshire Hathaway compounds year by year. The total equity increased almost 10 times over the last 20-something years, and that is how it adds value to investors. The S&P 500 has a dividend yield of 1.22% and some growth. So yes, the businesses there are great, but there is price risk, the same as with Berkshire. And if we put this now on the investing quadrant, the S&P 500 is here now. The long-term returns will be around 3 to 4%. If the market crashes 50%, of course, the risk is automatically lower and the reward higher. If we go to a 2009 situation for the S&P 500, the risk would be extremely low because you still own the greatest businesses out there, which is low risk, high quality at a great price. This would make the S&P 500 a great buy. The same can be applicable to Berkshire, that we recently analyzed and discussed, and I have actually put it at a lower risk situation, higher reward, because Warren Buffett sold Apple, and now Berkshire, given the cash position, is a higher reward situation. Of course, if I go to a 2020 situation, as we discussed in this video in March 2020, when Berkshire gives 10% expected returns, then it is a great low-risk buy. For now, it is here, it is much better than the S&P 500, that is lower, and that is something that you can always use to compare investments. I hope you enjoyed the quadrant. You can follow it, of course, here on YouTube. You can subscribe to the monthly Value Investment Quadrant newsletter, also commenting on the stock that we analyze, which is what we do a lot, and you can also check it on the investment course in the link in the description below. Thanks for watching, I'll see you in the next video.